to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
And welcome. You're listening to the Financial Survival Network, and we're back from Thanksgiving holiday. Hope you enjoyed yours. I know I enjoyed mine. Family, all that good stuff. Managed to do it without getting into any fights, which is always an accomplishment. But you too can do that. Just restrict alcoholic intake, and anything is possible. And hey, what about the Swiss? You know, I never saw them as a financially ignorant population, but 80%, yeah. Well, here to talk about it for our Monday morning chat, John Rubino, dollarcollapse.com, co-author of The Money Bubble. John, what about those Mets, huh?
Hey, Kerry. Yeah.
What about those Swiss? Man, losers.
Week, you know, for a holiday week in the U.S., it was extremely eventful around the world. And the Swiss thing was pretty big. But in retrospect, it was the postmortem on the Swiss gold referendum is it was just too complicated. You know, there were too many things for people to vote on. And so that anybody could look at it and find one thing that scared them out of all the stuff that was involved in the Swiss gold referenda. So that's apparently what happened. Everybody saw something to be worried about, so they voted no just to be safe, and that's that. But still, it was a good conversation to have. Yeah. And it turned out to be relatively minor in the scheme of things, because last week had a lot of stuff happen that matters dramatically to the global economy. So mind if I just go through a quick list of high points?
Before we do that, though, let me just, in case you just tuned in and you haven't had a chance to get over to Kitco, last night when the results of, and I'm talking Sunday night, when the results of the Swiss gold referendum came in, I guess it was like late in the afternoon, gold started going down, and it was just getting utterly decimated, down as much as like $40 the ounce. Wake up this morning, I look at my app on my smartphone, and gold's only down $10, and silver was down $1.50 yesterday as well. So I look at the smartphone app. Hey, it's only down $10, not the end of the world. And silver is only down $0.50. So I go off to Starbucks to talk about the world with my buddies there, and I just pop up the app. All of a sudden, gold's up $25, silver's up $0.50, and now we're talking 11:50 Eastern time, and gold is up $34.10, and silver is now up 84 cents the ounce. So you see what kind of lasting impact the market had from the Swiss gold referendum. I think it got discounted Friday night when they knew it was going to be defeated, John.
Yeah, a lot of it was already built into the gold price because the polling data had been really negative for the week leading up to the vote. And but also markets do what they want to do, you know, and we give reasons for what happened in retrospect, but that's just us trying to impose some patterns on a world that in a lot of ways has no pattern. You know, that's how markets work. But at the same time, if we're going to impose some reasons on what's going on, at the same time that the Swiss data came out, India made a surprise announcement that they were scrapping some of the restrictions that they've imposed on gold imports. And India is a huge importer of gold, and they would be much bigger if the government didn't try to limit gold imports, because the government's worried that all the gold being bought by Indians is throwing their trade balance out of whack. And so they've had restrictions, various kinds of restrictions on gold imports for the last couple of years. They just scrapped one of the big ones, which was the 80-20 rule that said that if you import some gold, you have to export 20% of whatever you imported. So the jewelers in India, they can go ahead and buy gold, but then they have to find a way to sell 20% of it when they make jewelry out of it to the rest of the world. And that was a hassle for them. You know, it made their lives harder. So that's been scrapped now. So they can sell all the jewelry they make to locals who really do want it. They are big buyers of gold jewelry in India. And so presumably this means that more gold will be imported and kept domestically within India, which is really good for the gold market because the gold jewelry that Indians buy tends to be saved in the same way that in the West we save gold bars and gold coins as money. And we don't just sell it because the price went up or down a little bit. It just stays where it is for years and years. And so that gold is effectively being taken off the market in India. So that's very good for the gold market.
Exactly. And yeah, it's important that you understand that gold in India is for investment purposes. It's 22 karat. So they make it into jewelry, but it's really at 22 karat. That's damn near pure gold. I mean, that's the same purity as an American eagle. And, it's there as a form of savings for the average Indian and for the dowry for the Indian wedding season, which is upon us. And, that's what it's about there. They trust their government as much as you trust your government, right?
Well, they're more realistic about their government, I think. They have a history of monetary instability over there, and so they have learned over 1,000 years that gold holds its value, and so that the kind of jewelry that they give as part of wedding dowries is thought of as monetary jewelry. In other words, it's wealth that you're going to save, and it's going to help your family get through hard times should they come, when the paper currency that your government produces is reduced to confetti, as happens all the time, in human affairs. And so when they buy jewelry, it's the same thing as us buying gold coins and putting them in a safe deposit box or burying them in the backyard. That it goes off the market and leaves less gold for other people to buy in the future, and other things being equal, makes the price go up.
Yeah. And so we got more good things to look forward to here. Swiss referendum, not the end of the world, although my own personal opinion, John, is it was our last chance at averting a collapse directly. Okay. I think that if the Swiss could have agreed to stop inflating, which is effectively what that referendum was about, right? Because by fixing 20% of the, having a 20% gold reserve requirement, they were saying you can't go on printing these fiat francs anymore. I think that would have made the Swiss franc the most stable currency in the world, would have broken the peg to the euro, which is the most unstable major currency in the world, and would have let in an era of prosperity for the Swiss that they haven't seen in quite some time. But like you said, it's all in the details, and the details weren't going our way. That's for sure. But so your latest article about really instability, and I guess the product of instability, John, is chaos. Chaos is breaking out all over the place. I mean, copper below $3, Dr. Copper. Like, I'm not smart enough to know where the world economy is going, but I do know that copper price is crucial to you understanding it, right?
Well, yeah, last week while we were getting ready for Thanksgiving and then pigging out and then recovering, and a lot of things happened, and most of them very bad for the global economy. For instance,
I like the way you put that.
Yeah, we weren't paying attention, so it's good that we're going to talk about
while you were asleep.
Yeah,
while you were drunk, and while you were getting pissed off at your uncle who you can't stand anyway, and you really wish hadn't come over to your house in the first place. Yeah. There was actually things going on in the world, right?
Yeah. So you could have been watching horrible economic news instead of arguing with your uncle. It's kind of
like John and I.
6 of one, half a dozen of the other.
That's what John was doing. Yeah. John was watching horrible economic news, so you didn't have to.
I'm willing to make that sacrifice, Kerry. But so here, check out what happened. French unemployment hit a record high. And so did Italian unemployment. And this is 5 years into a recovery in Europe. Oil's price fell again by 13% to its lowest level since 2010. Copper, as you mentioned, is down 25% now. It fell big last week to 25% below its high of just 1 year ago. That's a huge move for a major industrial metal in such a short time. European bond yields fell to record lows last week. Even Italy, with government debt above 130% of GDP, that's a horrendous number, and would normally be something that would make you not want to lend money to somebody like that. They can now borrow for 2% for 10 years. And Japan just issued some bonds with negative interest rates. In other words, you got to pay them if you want to own their bonds. And so European inflation is approaching zero now, with several eurozone countries in deflation. Mm-hmm. And meanwhile, while all this is going on, this is massive deflation across the developed world. The emerging markets have the opposite problem, because their currencies are now plunging against the dollar, because the dollar is getting stronger and stronger. And that's causing inflation in these countries. And so Brazil, their president just announced that she would use immense effort to slow the Brazilian inflation rate. So they're having problems that are the mirror image of what's going on in the developed world, but just as debilitating. It's just a bigger problem to have spiking inflation as deflation. And so what's happening out there now is, in a word, instability. Everybody's got a really serious trend that is accelerating in what to them is the wrong direction. And nobody really knows what to do about this. The European Central Bank is going to aggressively increase quantitative easing in the next year at some point, if they can get the Germans on board. But quantitative easing hasn't worked. Japan did it last year. They doubled the size of their central bank balance sheet. And now they're dropping into recession after printing all that new money and pumping it out and pushing interest rates down to zero. The economy's not growing. And presumably the same thing is going to happen to Europe, because they've got the same kinds of demographic and other structural problems as Japan. So go ahead, push interest rates down even further, to zero or to negative rates, and pump a bunch of money into the banking system. And their results will probably be similar to what Japan is seeing right now, which is bad, really bad. And so the question then is, can the U.S. stay this island of stability when the whole rest of the world is imploding in one way or another? And the answer is probably no. You can make the case that the dollar is the only game in town, and capital is going to flow into the U.S. As a safe haven. But at the same time, how are we going to export anything to the rest of the world if this is happening? And what happens to our junk bond markets? We have lent huge amounts of money to shale oil producers, for instance, and lots of other questionable borrowers. But the whole energy sector thing is the really scary one now. With oil prices down dramatically, a lot of the junk debt that was taken on to ramp up drilling in alternative kinds of oil sources and gas sources, those bonds aren't good anymore. A lot of them are going to default. A lot of the rest are going to trade at very low levels. And so that feels a lot like the subprime mortgage sector of, say, 2006, 2007, where all of a sudden the market has turned against these guys, and yet the banks have lent huge amounts of money to borrowers which are no longer investment grade or anywhere near investment grade. And so we're going to see a wave of defaults in the energy market that could be the catalyst for a cascade failure of the whole U.S. junk bond market. And will that pull down the rest of the financial system here? Maybe, the powers that be didn't think subprime mortgages had the ability to affect the rest of the financial system back in 2007, and they did. So I would say that this last week is a sign of things to come, because none of these trends are going to be easy to stop. And so they're going to continue for a while until something blows up. So 2015 is going to be a fascinating year when all of this stuff continues to the point of something serious happening to resolve it. And what it will be, who knows? There's so many moving parts to this story that there's no way to know what the catalyst is really, or what the resolution is. We just know it's going to be volatile going forward.
Interesting times, as they say. Hey, when it really hits the fan, that's when precious metals going to make all the difference. Mm-hmm. And right now, they seem like they're just a barbarous relic, John. But and I know that that things go on until they trend, a trend in motion until it's no longer in motion. And we're getting to that point here. And, you know, the powers that be always want to project the impression that they're in charge, that things are going exactly the way they're supposed to be. And, you know, we've got everything under control. But the reality of it, let's face it, is something totally different at this point.
Yeah. Oh, and Kerry, I forgot to mention maybe the most important stat of everything that came out last week, and the scariest of all is, you know, how we've been talking about China and all its malinvestment over the last 5 years in those ghost cities and stuff like that. But nobody really had a number. It just seemed huge. And so last week, it was reported that the number for Chinese malinvestment, in other words, bad debt that has to be worked off somehow, either through default or through bailouts, is 6.8 trillion. And that's 2/3 the size of the Chinese economy. So that is a huge number in relation to China, and really, you know, in relation to pretty much anything. $6.8 trillion of bad debt is bad news for everybody, not just for China. And so now we kind of have an idea of what China's problems are, and they're immense. So yeah, you would think that in a world like this, precious metals would be the safe haven, because everybody basically is in a situation where either their currency is being rapidly depreciated, as in the emerging markets, or it has to be rapidly depreciated, as in the developed world. You know, Europe has no choice but to devalue the euro. And Japan, over the last year, has aggressively lowered the value of the yen. And so the U.S. can't be far behind, because if we have a dollar that goes up next year as it has gone up this year, what happens to our export industries? You know, a strong currency is a vote of confidence, but it's also a problem for huge sectors of an economy, especially an over-indebted economy. If you borrow too much money, then you don't want your currency to get more valuable, because you got to pay your debts back in the appreciated currency. So that's a bad deal for you. It makes it harder and harder to pay off your debts, and it increases the likelihood that you won't be able to. And that's what we'll see next year. If the whole rest of the world implodes and a bunch of currency or a bunch of capital flows into the U.S., then that becomes our problem. The rest of the world is basically exporting their deflation to us. And so the U.S. could go from being the island of stability in 2014 to the catalyst for a global financial collapse in 2015. Fascinating times, huh?
Yeah, and I think you've exactly nailed it. The Chinese bad debt and the malinvestment, because let's face it, malinvestment always winds up as bad debt, right? One way or the other, whether the government has to rescue you from it or whatever. Malinvestment, because by its very nature, it's investment that shouldn't have been made in the first place, and due to, in this case, artificially low interest rates, easy money, bad government policies, you know, go on, you fill in the blank here, John, you know, it winds up being bad debt. It means it's on the books of a bank or other third party, and the outcome, it's just not going to be good here. And I guess I'm being a little oblique here, but let's face it, you know, it's really bad, and nobody wants to fix this bad debt. And that's why we go back to my initial means of dealing with this, which has always been a debt jubilee, whatever you want to phrase it. I mean, people don't like jubilee, Bible, blah, 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 but there is no other way to handle it other than to basically liquidate it, get it off the books, convert it to equity. But how do you do that for countries? You're going to sell off pieces of countries. They tried that with Greece. People really appreciated that. There's no other way but to get rid of this debt. The debt overhang is really where it starts, and the debt overhang is really where it ends. And until you really get serious about dealing with the debt, what else are you going to do here, John?
Well, yeah, bad debt has to be worked off somehow. Bad debt, as defined as something where an investment was made that isn't generating enough cash flow to pay off the related debt. Okay, we have tens or hundreds of trillions of dollars of stuff like that out in the world, and it has to be worked out one way or another. Either you just stop making payments and you default, or somebody bails you out by giving you more money that you can use to pay off the debt. And traditionally, a lot of malinvestment has been worked off through defaults because the world, up until very recently, operated on sound money, where you couldn't just get more gold or silver in order to pay off a bunch of bad debts. So there were mass defaults. You had a depression or an extremely nasty recession. The debt got worked off, and then you could start over from a more sustainable base. Well, in the last 10 years, because we have fiat currencies, we've got unlimited printing presses, we've decided to go the other route, which is to have the government create huge amounts of new currency and then kind of sort of pay off those bad debts as they come due. And that's what has kept us out of a 1930s style depression, but it's come at the cost of huge amounts of new debt being taken on. So our problems are even bigger now than they were a decade ago. And so the solution has to be even more extreme. And clearly, that's what we're going for. Clearly, we're going to, one way or another, try to bail everybody out. But to do that, you got to create a whole bunch of new currency, give it to debtors, and the debtors can then use that currency to replace their debts. But in the process, you've created all this new currency, and that becomes destabilizing. So you shift the problem from too much debt that's going bad and too many defaults that are on the verge of happening to too many weak currencies that are on the verge of collapsing. And so basically we're substituting or swapping a debt crisis for a currency crisis. And that's what we'll get going forward. If we bail out, $6.8 trillion of Chinese bad debt and probably comparable amounts of bad debt in Europe and Japan and the US, if we try to bail those bad debts out by creating huge amounts of new currency, then we get extreme instability. There is really no way to predict how that goes because we've never been there before. We've never created $20 trillion of new currency and just shoveled it out into the global financial system. And so we're, at it. Oh yeah, we're living through the most fascinating time in human history from the standpoint of economic theory,
Yeah, well,
because we're trying some things that are so experimental. This is just us trying things just to see what'll happen. So we're generating a lot of data, but a lot of it's going to be very unpleasant data when the results finally come in.
Economic data, economic theory has a way of becoming economic reality, wholly different and detached from the theory. And we're going to be living that theory, and it ain't going to be fun. Hey, find John's work over at dollarcollapse.com. I think it's must reading. He does a great aggregation job. Go over to financialsurvivalnetwork.com. Check out Stefan's latest work at putting together what's going on here in the real world, not the fantasy world that the mainstream media is so intent on portraying. Sign up for our newsletter. You want to support the show, clubfsn.com. We appreciate anything. We're trying to get these video channels up and running. We've set the deadline for first quarter of 2015. John, next week. Thanks so much.
Thanks, Kerry. Talk to you then.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.